Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan and here with Adrian Nicholson. Adrian, how are you doing today?
I'm doing all right, Roshan. The change in time is kind of throwing off my schedule a little bit, but we got a fun topic today, so I guess I can't complain too much.
Actually, I agree with you. I remember reading that there was a bill they would pass to get rid of the time change. I would love if they did that. Similar to what you said, I'm really excited about this topic today. We're going to talk about Peter Lynch's 25 golden rules for investing. And he wrote that in his book, Beat the Street. So we'll also provide a link where you can get the list. But he is another one of the great investors that I love to read what he's written, learn from him, take what I can to make myself a better investor. And I think these golden rules are a really good one to review for our listeners that haven't read it, and really give our thoughts on these rules on how you can use it today. I'm always a fan and focused on trying to make these things usable.
Yeah, I'm really looking forward to it, Roshan.
All right, so let's go ahead and get started with it right now. So, rule number one, and I don't think he wrote this in any necessarily in an order, but it says investing is fun and exciting, but dangerous if you don't do any work. What are your thoughts on that first rule?
So I agree with the last part, talking about how it can be dangerous if you don't do any work. It kind of just leads to investing in the unknown, which can hurt performance. And then the first part, we talked about it on the previous podcast where we talked about how investing should be boring and not exciting, because that's a way that could lead to better performance, keep you objective, which can help out. And then Peter Lynch here is saying it should be fun and exciting. So right off the bat, I'm disagreeing with part of what he's saying.
Well, that is a great point. I want to make our disclosure before we continue. This is not investment advice. This is just an intellectual discussion about investing. Please consult with your advisor. Anything that Adrian and I discuss does not apply to you specifically. We just want to give you thoughts and ideas to become a better investor. If you need help, please reach out to us. We'd love to talk to you specifically to see how we can help. So, Adrian, now back to your point about investing is fun and exciting. I think you've got to think of the source here for a minute. Peter Lynch is an investing nerd. It is fun and exciting for him, right? And
Mm-hmm.
I would agree with that. Where I do find it fun, exciting, interesting. I like looking for the different investment companies. I'm sure you've heard me say this many times, but I feel like I'm like digging for gold, so to speak, where I'm reading through reports to try to find these great opportunities to profit from, and then when they do go up in value, it's the greatest feeling that you're validated your work was worthwhile. But I don't. When we're talking about not exciting or fun, in my mind, that really does compare to what we talked about on I believe was our last episode when we covered, which would have been episode 198, when we went over Warren Buffett's annual letter to shareholders, where he talked about the markets being very much like a casino now. So when I hear the fun and exciting thing, I think what Lynch is, when we say it shouldn't be fun and exciting, I think we're saying it shouldn't be like a casino. I think
Mm-hmm.
when Lynch is saying it's fun and exciting, I think it's fun and exciting for him to do the research and analysis, which a lot of people would find fun and exciting. So I don't back away from what we said previously, or I think I'm just giving greater detail on what I think Lynch is going for here.
Mm-hmm. Yeah, I appreciate you expanding on that. So that's a good point.
But the other side of that statement, dangerous if you don't do the work. That's
Mm-hmm.
where I'll come across people like I was my barber will talk to me about investments all the time, and he will buy stuff that is the hot thing, or he heard about somehow that has many times has gone down in value, and he'll ask me about it, and it'll be these speculative names. The most recent one went out of business, and he was like, will I get anything? And the answer unfortunately was no. But that's where, and I'm not throwing my barber Sam under the bus if he's listening, but that's where that's, to me, is where not doing the work comes into play, right? It's a name you've heard from someone that says, hey, this is good. And the most frequent thing when someone's talking about an investment, or when you read an analyst report, is what time frame are they referring to, right? So just using my barber, for example, he bought this stock and he owned it for a while till it went to zero. Maybe whoever told him about it was buying it for a month, right? And then selling it. They don't have the conversation, and then one guy makes money, one guy loses money on the same thing, right? So I think that's also important. Rule number 2, your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. And I've seen this. I've had a client in the tech space that he had said he saw a company getting a lot of business in the space. He bought the stock. He owned it for 2 years, where he lost over 50%, I think, of what he put in. Fast forward now another 2 years, and his money's doubled, right? So in a 4-year time frame, he went from cutting his money in half to doubling his money. And his edge was through his work. He saw a company was getting a lot of business, and thought that they would continue to do so because he thought they had a good product. What thoughts did you have on this one?
So I like this one a lot because it just makes me think of just the products and services that, I use and other people use in their everyday life. Typically, those products and services have sometimes a company behind it that you could potentially invest in or look more into to see if it might be a good fit. And I think that's what this rule is really showing you, that, yes, you can go out there and get other people's opinions and look at other sources to see what opportunities or what investments might be out there. But sometimes it can be as easy as just looking around at the room that you're in right now and say, hey, what am I using? What's something that I like? What's something that I enjoy? And sometimes that can lead you to something where you look at it and say, hey, this might be an investment opportunity because it's a big part of my life. It's something that I spend money on. And I think that too is something that just gets applied to the individual investor here. Everybody's different. Everybody goes through different experiences, different stage of lives, which leads them to different products and services that other people might not be familiar with, that could give them an edge when it comes to looking at it and understanding it and seeing if that can be a good investment opportunity for them.
Yeah, you talked about things with everyday life. I'll give you one example that in retrospect, I did not invest in this early, but early, I don't even mean when the company started. I just mean it in 5-10 years ago when I saw it. But an obvious one to me, looking back, is Amazon, right? I was using, and the thing with Amazon is their ratios always looked overvalued. Historically, they've always looked overvalued, but I could see my consumer habits as soon as I had my son Dylan. We that was almost 12 years ago. We signed up for their subscribe and save for diaper delivery. And then they get you with, they tell you, if you add more things to subscribe in, you get a further discount. So I could see my own habits of just using that more and more at the time. And I did not take advantage of it by investing in it at that time, but it would have been very profitable to do so. I'm by no means saying you should have done that. I to a certain degree, stand by my decision to not invest in it or add to it based on those numbers. But I wonder, had I done more research or spent more time and analysis on it, if I would have thought differently. I had read something, it's only been about 2 years ago now, but it was a real deep dive into the history of Amazon and their businesses, and showing that they were always, and they still always, reinvest intentionally to not only to expand or grow, but it also makes them more tax efficient. So that's just an example of something you see in your everyday life. or if you see other things that are just continue to expand or grow, but using your personal experience, that's something that Peter Lynch is very famous for saying, that you can have an edge there. One other thing I'd like to add on that I think is an important one is that I think time can also be your edge compared to the Wall Street experts. Oftentimes you look at them talking about 1 year down the road. A lot of the professional money managers are looking a quarter at a time, because that's when their performance gets listed, and they see how they've done. So sometimes if you have a mutual fund, that mutual fund's time frame may not fully align with yours, and if you've got a longer term perspective, that could potentially be an edge for you.
Mm-hmm. Yeah, I agree with that, Roshan.
All right, number 3. It says, over the past 3 decades, the stock market has come to be dominated by a herd of professional investors. Contrary to popular belief, this makes it easier for the amateur investor. You can beat the market by ignoring the herd.
Mm-hmm.
What thoughts do you have on that?
Another one that I'm sure will lead to a deep discussion, but we'll try and condense it as much as possible. But this is sometimes, it can be difficult just going against the herd, what people are saying. And I think this can kind of help what you just talked about is a time frame too. That could be different than what people or the herd in this rule is going against, saying, hey, there might be some short-term volatility. We don't like the short-term outlook, but maybe you have a long-term outlook and say, hey, I can accept that, and I can go against them telling me what I should do today. So I think that's something too that you should consider as well when you're looking at this rule.
Yeah, and I look at this, and it's contrarian investing. Is there are people who focus and almost specialize in that. Buffett's been known for that. I read a book years ago by David Dreaman, who's known to be a contrarian investor, and oftentimes you can find things the market doesn't like and is punishing. And I mentioned time as an edge earlier. It might be a short-term issue where that's an opportunity to buy. I think of housing over the last couple years. From 2022, housing stocks were getting beaten up because the Fed was going to raise interest rates, and the concern is people would buy less houses if interest rates go up, because the payments high, it becomes higher. And that was a very good opportunity for anyone that looked into that space and invested in that space at the time. I think a little bit going back further to the Great Recession era, and there were bonds in the housing space, mortgage-backed securities that went down significantly because of what was going on, and was a good opportunity. So there are definitely great opportunities there. Rule number 4. Behind every stock is a company. Find out what it's doing. Seems simple. Yeah. What do you think?
I like this one a lot. And I think sometimes when people look at stocks, sometimes they can just be reduced to a price. And what Peter Lynch is saying, hey, it's not a price. It's a company. It's a business that offers a product, a service. They have revenues they need to focus about, costs. They have a balance sheet. And that's something where you have to focus on, other than just the movement of the stock price day in and day out. You have to see what this company is doing, because that really can paint a picture on what the price is doing. Sometimes, not always, but that's just something that you have to look at that can help you with your future investment decisions and just managing the stocks in your portfolio.
Yeah, and I going back to what we said on previous episode 198, Warren Buffett talking about the markets becoming a gamble. Oftentimes I'll hear people say a stock is cheap or expensive just based on its stock price, right? Mm-hmm. And companies will do stock splits, or some will choose not to, but the psychology of it is a big impact. But that psychology does not have an impact on the business behind it. Right. Mm-hmm. If you have $1 million business and one share is outstanding for $1 million, that's the same as $1 million business with 1 million shares outstanding for $1 each. both businesses are still worth $1 million. One just has a single share outstanding, the other has 1 million, but it's the same thing. And as you said, you've got to look into the company, what it's doing, and it's really easy now to find because all the information is at your fingertips online. You can go to the company's website, to their investor relations section, pull any of their filings, typically to the SEC, get quarterly reports, presentations breaking down the business. So it's really easy to find out, and you can really quickly find out a lot about a company, almost probably more than you might even want to know in just a few minutes online.
And it can help just fuel your investment decision on just deciding, is this stock worth keeping in my portfolio or not, honestly, because if you do your research and you find out, hey, I don't like the numbers they're seeing, or I don't like the direction that they're headed, that can be something that you didn't know before, or vice versa. So that's, I think, is a great rule to really help people understand their portfolio overall.
Yeah, and this a lot of these rules, this one included, aren't unique to Peter Lynch, right? They're rules that many investors have talked about and stand behind. And once again, knowing that it's a stock is not just a ticker symbol moving around. There's a company behind it, and Buffett has said that if you ask him what he does, he's a business analyst because he's analyzing the businesses. Let's go on to rule number 5. And Adrian, I'll let you start us off this time. I'll just read the rule. Often there is no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. In the long term, there is a 100% correlation between the success of a company and the success of its stock. This disparity is the key to making money. It pays to be patient and to own successful companies.
Yes, this, I believe, goes along with the markets being a short-term voting machine, a long-term weighing machine, and how this applies to businesses as well. Yes, businesses have their own risk out there, and that's something that people need to consider, but there's also just market risk out there. You could have a great business, a great stock out there that is doing well, strong earnings, good forecast, great balance sheet. But for whatever reason, on the short term, maybe the markets aren't doing well, or there's a news out there scaring investors and everything's getting impacted by this. And I guess what they're trying to highlight here, what Peter Lynch is trying to highlight here, is that, over time, yes, it might take the stock a while to recover, but if this is truly a good business, if they're resilient, that over time they will be rewarded, that the price will reflect what the company is actually doing. And if it's if its business is going well, earnings are staying strong, over time you'll see it recover and start performing well. So I think that's something that they're trying to highlight here. If it's a bad business, then maybe even on the short term, it might perform well, but over time, maybe investors and analysts might say, hey, maybe this is not the right place to be, and it will show in the stock price.
Completely agree with everything you said. I definitely have a few things to add on this. I think this rule is very valuable. So I think it encompasses a couple things. One is in rule number 2, when I said time can be your edge, that's what I think one thing he's touching on here, right? And rule number 2 was saying an edge is not something you get from Wall Street. It's something you already have. So I mentioned earlier how some of these experts may not be able to stay until the price, the stock company shares line up with the success of the company. And you as an individual investor may have that time, because some of these investors are, these managers, they have to worry about their job security, and they may not be able to hold on to something for time to catch up, right? For the share price to catch up with the success of the business at all. This also touches on, to me, Adrian, in rule number 1, when you had said, I don't think it's fun and exciting. I think this is this part, the waiting part, is the not fun and exciting part, right? You do the research, you believe what you're doing, and then you just buy and hold, and you wait. It goes back to the coffee can portfolio we've talked about many times, where You buy shares, put it in a coffee can, and open that coffee can, theoretically owning your stock certificates before everything was electronic. You touched on Adrian Graham's quote: "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." So earlier I mentioned that a lot of these rules aren't unique to Lynch. He wrote them in his book. I like the list that he has, but it's been talked about before. So these are things that I look at that are oftentimes could be truisms about investing. When you see that so many of the greats follow these similar rules.
Mm-hmm.
So I think this is a really important and valuable one about what you can do as an investor. The last point I'll make on this before we move on is we also touched on this in our previous episode 198, where Buffett at the beginning of this year's annual letter talks about how Charlie Munger was the architect. And the reason he was the architect behind the success of Berkshire Hathaway is he's the one that said, instead of getting a fair or bad company at a good price, get a good company at a fair price. And I think this is also what Lynch is talking about here, that if you get a good company that is a successful business, over time, the share price will follow.
Mm-hmm. Great points, Roshan.
Yeah. Rule number 6, you have to know what you own and why you own it. This baby is a cinch to go up, doesn't count. What thoughts do you have?
I feel like we've just been talking about this little by little as we've been continuing this podcast, where it's just understand why you are investing in this company or this investment to start out with. And you just really have to evaluate and see if that's a good enough reason for you to own it, and what role is it playing in your overall portfolio or your plan. I think that's something too that you have to think about as well, and just really evaluate it and be critical of it, just to see if this is the right fit for you.
Yeah, and I think, Adrian, you do a great job always bringing it back to the plan and your goals, because at the end of the day, these dollars are resources for you to accomplish your goals. This rule number 6, you have to know what you own and why you own it. To me, this is what gives you resolve in the market, in any market correction, down cycle, or anything like that, right? The market goes up and down every day. Stocks move up and down multiple percentages sometimes in a day, but the business itself didn't change that much in a day, right? As we said earlier, there are businesses behind this. So if you know what you own and you're comfortable owning it for a long time, going back to rule 5, right? You've got to be patient until the successful company's stock follows the success of the company. And while you're being patient, there will be market declines. So for me, knowing what you own is so important, because when the market goes down, you've got to have the resolve to keep it. Hopefully you've done a good research and it's just a market cycle and the business is still well and it goes down. Or the other side, right? If it goes down and you know what you own and you think it's validated, you'll be able to sell and get out of it if it's showing that the reason you own it is not working out. The thesis on why it would go up is not working out. And his quote that he has, "This baby is a cinch to go up," to me just reflects the hot stock or hot tip that someone says, "Hey, buy this because it's going to go up," versus doing your own research and homework and saying, "Here's why I'm going to buy something."
Yeah, that's a great point that you added right there on it. It's just, what's the reasoning behind it? If your reasoning is just that's what's going to happen, that's just highlighting, hey, maybe that's not a great place to start.
Yes, agreed. Next, rule number 7, long shots almost always miss the mark.
Yeah, key word here, almost. I mean, I think they're just saying, typically if it's a speculative investment, there's the odds are stacked against you. It's gonna more than likely not work out, and maybe you know about that and you're willing to accept that, then that's great. But if that's something you're not willing to accept and you go in it with the odds stacked against you, it can be a recipe for disaster.
Yeah, and you know what's interesting is you had said the key word is almost. I don't disagree with that statement,
Hmm.
but I think the word always
Hmm.
is a very important one here, right? It's long shots almost always miss the mark,
Hmm.
and the reason I put it that way is yes, almost. So sometimes the long shots do work out,
Hmm.
but they almost always miss the mark. To me, I look at that and that says. Um, don't spend your time researching or analyzing or getting to know the long shots because more than likely your time is wasted. Now, if you find the right one, it can be very profitable, but it's the difference between consistently hitting singles and doubles versus always swinging for the fences. And you know, knowing that with the baseball analogy, if you're always swinging for the fences, the number of times you strike out will be higher than if you're going for singles and doubles.
Mm, yeah, this is definitely a risk reward conversation as well, just to be had here. If you
Mhm.
say, if this long shot works out, I can probably make this, but if it doesn't work out, I'll lose this. And then that's where you have to decide, all right, should I even consider this? Because if I'm not willing to take on that type of risk, then the reward, you can't even really think about it. But if the reward is awesome, it's great. It's something that you think that would really help out your situation, and the risk is something you can live with, then there's the other side of it as well.
Yep, we've talked about position sizing
Hmm.
on
Yes.
multiple episodes. I think that's a good point you're making here as well.
Hmm.
Rule number 8: owning stocks is like having children. Don't get involved with more than you can handle. The part-time stock picker probably has the time to follow 8 to 12 companies and to buy and sell shares as conditions warrant. There don't have to be more than 5 companies in the portfolio at any one time. Is another one that got me thinking and has a lot of information uh, packed into just a couple sentences. First, what are your thoughts on this, Adrian?
Well, first, it's an interesting analogy, basically comparing children's to stock out there and how much time you can apply to that. So I definitely like all the analogies that Peter Lynch has given because it just paints a pretty good picture for people to think about when it comes to their investments. Where, if you are managing a lot of stocks or children in this case, it can spread yourself very thin. And that's something that he's really just trying to highlight here. How much time are you going to be able to give to that stock, and how much research and homework can you do? And if you have a lot of them out there, it can really just impact you, and that's something that they're trying to highlight here. But the last part I'm having difficulties grappling with is the last sentence where it says there don't have to be more than 5 companies in the portfolio at any one time. And to me, that just seems like a diversification debate right there on if that's something that would be a good fit for somebody.
Yeah, I agree with that. And I wonder here, I had the exact same thoughts, by the way, that he's not talking about uh, being diversified. And you'll definitely find that a lot of the greats talk about concentration over diversification. Meaning that um, and this was a debate going back with the efficient market theory, which says that the markets are efficient and you can't outperform the markets. We've covered this on a previous episode, and I think what you talked about one word, all on rule number 7 being so valuable. I think what a lot of the investment greats have come to is saying the markets are mostly efficient, not fully. And because they're mostly efficient, when you find these opportunities, there are rare, few and far between. So you want to make sure you have a significant investment made in those rare opportunities to outperform those rare cases where the market gets it wrong. So I don't think he's talking about not being diversified. I think he's talking about, one, what do you have the time to handle? I think that's the most important point. And what I'm adding on to it is the fact that concentration, concentrating your portfolio into 8 to 12 companies, as Lynch is saying, versus diversification, owning a bunch of companies. I think you'll find a lot of money managers that do well talk about that concentration. Um, the one of the consequences to that concentration is greater volatility. And here's another debate in the investment world, right? How do you define risk? If you talk to an investment manager, they'll typically say the risk is can you lose money, uh, versus when you look at anything in the academic space, they'll typically define risk as volatility or standard deviation. How much does something move around? Right. And part of the issue is you can't go back and compare investments with, did people lose money? Right. Because stocks move around so much. Did you make or lose money depends on when you buy and when you sell. So I think part of that is from an academic perspective, you can't really do a lot of research and analysis if you use that rule of, can you or did you lose money? But you can if you talk about how much a stock bounces around. So I had the same thought you did. I just made the point that he's not talking about being diversified. I then just went a little bit further on here, and one of the foremost studies on diversification was done by Fisher and Laurie in 1970. The title of this is Some Studies of Variability of Returns on Investments in Common Stocks. It was published in the Journal of Business. And they look at standard deviation and R squared and tracking error of owning stocks versus the market. And their conclusion was at 15 stocks, you have about a 76% correlation to the market. At 30 stocks, you've got about an 86% correlation to the market, meaning that it can go up and down, but you're going to be mostly in line with the markets. So here, I don't think he's talking about being diversified at all. I think he's talking about what do you have time to follow. I also don't think he's talking about. Necessarily being concentrated. I added that on. I think it's more a function of time. But I did go to that diversification thought, and as I was going down that rabbit hole, I went and I found a consolidation of what looks like something like 100 different studies on diversification. And what I found is that the longer time periods they look at, they'll talk about more stocks needed to be diversified. And the shorter the time periods is when you'll see the lesser stocks being needed to be diversified. So if that's the case, if you're looking at it from a diversification perspective, I think you can even look at indexing as an option. Going back to rule number 1, where he says investing is fun and exciting but dangerous if you don't do the work. Well, if you don't do the work, there are a lot of solutions out there for you, from mutual funds to even indexes. And I think that to me, and Adrian, tell me if you interpreted this differently. As I said, my first thought was diversification. I just didn't think he was discussing diversification here. I think he was discussing time management here.
No, I mean, I definitely agree with that now, especially since you expanded on all those points. So I think it's something valuable for our viewers and listeners to understand, because this is an important concept when it comes to especially structuring your portfolio.
Yeah, and let's go on to the next one. Rule number 9. If you can't find any companies that you think are attractive, put your money in the bank until you discover some. What thoughts do you have on that?
So the first thing that came to mind for me on this one is the current risk-free rate. I mean, that's something that people need to consider now, especially if rates being higher, and you can actually make more money on what this rule is talking about, money in the bank. So that's something too that you have to weigh, because if you can't find any opportunities out there and you don't think that putting your money in a certain investment will be a good fit for you right now, it could be a safer place just to earn as much interest as you can on this on your cash.
Yeah, and I love this one as well, just because you don't have to take action, right? If you can't find companies that you think are attractive, put your money in the bank until you discover some. He's talking about what you're doing now, right? In the future, things change and the markets present opportunities. they do go up and down, and there may be an opportunity in the future. It's interesting that this comes up now. I looked into a company last year. Yeah, I was looking into them last year. Decided that I didn't like the risk of the stock or where the business was at the moment. They were declining, and I thought I just need things to stabilize. Well, fast forward a year, the stocks dropped by about 50%, and I just started looking at it again. Right. And we're a year further along. The company has started to stabilize. I think I don't know that we're at the bottom yet of that specific stock. And when I say at the bottom, I'm not referring to the stock price. I'm referring to the business. The business was a decline. They were in healthcare during COVID. They took off and had blockbuster years. Post COVID, things were starting to decline, and now they're starting to, I believe, stabilize. Not quite there yet. I don't know if I'm going to buy or this investment or not, but how this applies so well to rule number 9 is if this was the only investment in the world, I saw it last year and I left my money in the bank because at the time I didn't like the opportunity. You fast forward a year, the stock has been cut in half and the business appears to be starting to stabilize. This may be an opportunity now that I would look at. So remember, when you make that decision to leave it in the bank now, that's not forever. That's just for now.
Mm-hmm. Yeah. I mean, great way to add it.
Rule number 10, never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Always look at the balance sheet to see if the company is solvent before you risk your money on it.
Yeah.
What thoughts do you have, Adrian, here?
The value investor loves this rule. I mean, this is as clean and cut and dry as it gets when you're looking at a stock, seeing if it's a good opportunity, if a company's worthwhile investing, because again, balance sheets have actually been really the focus nowadays, especially with higher rates, because you have to look at companies' assets and liabilities. Do they have a lot of debt? With high interest rates right now, that can be a significant impact. And just what he said in this rule, solvent, are they liquid? Are they able to cover anything that comes up, or as any expenses? So that's something that is really telling when you look at a company as well, depending on what the current economic or market environment is, on whether this investment or company is going to perform well in the future.
Yeah, and I think there is a lot of information in here as well. I've talked a lot about Benjamin Graham, and what's interesting is they don't necessarily say, that Lynch is, from the Graham school or is a value investor. He was more of a growth at a reasonable price type investor. But I bring this up with Benjamin Graham, because he viewed these companies, very much like a banker. And are they going to stay solvent? And I think that Lynch is saying the same thing. And he literally saying the same thing. You have to always look at the balance sheet to see if the company is solvent before you risk your money. There are a few ratios and things I just want to share with all the listeners when you're looking at this, because if you're thinking, what do I look at the balance sheet? First, the current ratio. It shows you liquidity of the company. Can they pay their short-term debts? They take their total current assets and divide it by total current liabilities. So you're typically looking for something that is, the higher the better, but a 1 or better at least. Next, we've got the quick ratio. That is almost the same thing as the current ratio, but it takes out inventories. And actually, before we move on, I just wanted to look this up. The current ratio, the higher the better, as I said, but 1.2 to 2 is typically what they're saying is where you've got to be. I've seen 1.5 to 3 as another number, but once again, the higher the better. Definitely below 1 is cause for concern, but below 1.5 maybe cause for concern. The quick ratio excludes inventories, because if the company's got to fire sale their inventories, they may not get what they're carrying on the books. So that's just a more conservative ratio. Cash to debt it tells you the financial strength of the company. If it's less than 1, it means the company can't pay off their debt with cash in hand. A lot of companies with debt can't pay off their debt with cash in hand, which may not be a problem, but that's where you'll also look at the current and quick ratio and some other indicators. Debt to equity. Yeah, how much debt does the company have? Their total liabilities divided by the shareholders' equity. You definitely want to be around that 1.5. But the more debt you have, the more homework you've got to do, right? To research maturities. Well, looking at all the other ratios. Once again, here you're looking for solvency. The last one I'll touch on is the interest coverage ratio. That'll tell you, can they pay their interest expense? And you take the company's operating income and you divide it by interest expense. Once again, the higher the ratio here, the better. So if you have a company that has, no debt, you don't need to worry about a lot of these things I touched on. If they have minimal debt, a lot of these ratios will look good automatically. And once again, we're looking for solvency, meaning they'll be solvent. If they aren't looking great at these ratios, that may be a good enough reason to walk away. Going back to Buffett's analogy with baseball, every investment, every stock symbol, every business out there is like a pitch, and you can wait for the fat pitch where you can get a good hit, right? You don't have to swing at everything. So it's easy to walk away and say, I don't want to spend time on this company. I'm going to walk away and research the next one. So if you see something you don't like, just walk away.
Yeah, and it can save you time. And these ratios are a way for you to maybe filter through companies quicker and help you see, all right, well, this doesn't fit the criteria I'm looking for. I don't really like companies that take on a lot of debt. I can just move on to the next one and save yourself some investing time.
There are definitely investors out there that will avoid companies with debt, period, right? They'll look for companies with no debt. That's just part of their criteria. So you build your own criteria. That's really what we're trying to help you do with these rules. Rule 11, avoid hot stocks and hot industries. Great companies in cold, non-growth industries are consistent big winners.
Yeah, I mean, this is another one where I think the thing that stands out to me on this one is the word cold. It says great companies in cold, non-growth industries. And I think what they're trying to point out here is that's a great opportunity. If you have a company that's really thriving when its competitors and the people closest to them in that industry or in that sector aren't performing as well, that's an opportunity for them to take market share and just really show that this is why this company is thriving right now. And what we talked about earlier, over time, that company should be rewarded for its stock price.
Yes. Yeah. And I think this rule ties back to what he said earlier about being contrarian, right? That you're not following the herd. So that's a good thing here. To me, what stood out, and I can't name the investor that said this, but it's that the price you pay is what determines your outcome, right? So what you pay for that stock is what determines how you do in the long run. So oftentimes the hot stocks are stocks that have a run up in price. And so you end up paying a little bit more than you would for another stock. And maybe they're growing more, but the other stock may be a better price. It's a tough one to balance here because I do, going back to what we said about Munger saying get a good company at a fair price versus a good price for a bad company, where I would say this is an important one, but there are a lot of companies out there that will have fair prices that are continuing to do well and expand their business. Rule number 12, with small companies, you're better off to wait until they turn a profit before you invest. What thoughts do you have on this one?
It's always good when you see a consistent and positive track record, and that might be a good way for you to say, hey, maybe I'm looking at this investment for a while. I didn't really like the things I saw earlier on, but now I'm starting to see consistent returns, or maybe a stronger balance sheet or a more positive outlook, and that can be an indicator for you to say, hey, maybe now I can start starting an initial position in this small company that I like, other than just saying, hey, I like this company, I'm liking what I'm seeing, but right now I'm really seeing some negative news or negative numbers coming out of this company. Maybe I should try and take on this uphill battle, and it might not be favorable for you.
Yeah, yes, and I like this rule now with Peter Lynch. I don't think I gave him a proper introduction because I'm a fan of his. I just almost assumed everyone knows who he is, but he's one of the most successful investors. He managed the Magellan Fund for Fidelity, which really did put Fidelity on the map. And he did it for 13 years, from 1970 until 1990. And when people look, he had what was called a capital appreciation fund, meaning he wasn't locked into a sector or an industry or a style. He could go and invest anywhere. And a lot of people thought his track record was so good because he was able to invest in smaller companies. I bring this up because first is his track record, and the fact that he invested in smaller companies, I think shows that he's coming from a place where he knows what he's talking about. I only make that point because I wonder if people look up his fund or look up Magellan because it was so big, they would assume he was only in large companies. But no, he did invest in small companies. The second thing I'll point out here is a lot of small companies don't make it, right? They'll go out of business. They won't ever become positive from a revenue perspective. Some of them, it's through the tech bubble, a term called pre-revenue became a term people use all the time now. When businesses are seeking money from venture capitals, even going to the market, they'll say they're pre-revenue and worth $1 billion. That's what a unicorn is called, right? They're not always pre-revenue necessarily, but getting $1 billion valuation. So I really like this point here because I think that'll help you avoid some of those major losses. It'll eliminate some of the hot stocks he talked about earlier. It'll eliminate some of the balance sheet issues he talked about earlier if you just wait until the companies are actually making money before you commit your money to it.
Yeah, I mean, the timing can be difficult for anybody to figure out, but it's hard to really ignore it when you're thinking about starting something like this.
Yes, it definitely is. But I like a lot of what he said in these rules. When I was introducing Lynch as well, I also forgot to share that he averaged 29% a year for those 13 years. So the fact that he had such a big fund he was managing and able to do that, 29% a year means your money doubles every 3 years. And you're comparing that, I don't know exactly what the S&P did in that time frame, but you're probably comparing that to around a 8-10% neighborhood as far as returns goes. Just shows how good he was as an investor, and why people were looking for rationale as to his outperformance and how the small companies come into play. Now we'll go over one more rule today, which will be rule number 13. And then we'll continue in a future episode with rule number 14 through 25. Rule number 13, if you are thinking about investing in a troubled industry, buy the companies with staying power. Also wait until the industry shows signs of revival. Buggy whips and radio tubes were troubled industries that never came back. I think this is a great one. I have to add, as I have many times in here, a Buffett quote. He wrote in his 1979 a letter to investors that, and here's the quote, both our operating and investment experience cause us to conclude that turnarounds seldom turn. So, and Lynch is saying wait until it turns or look at the leaders in the industry. I'd say from Buffett's perspective, he's saying don't waste your time on a turnaround. And my experience definitely not as extensive as Buffett or Lynch on this, but I've seen similar things where I would almost want to avoid things that are turning around. I put a caveat to that, like earlier we were debating the word almost and always, because sometimes there are opportunities there, but I will share with investors, with our listeners, that there is a company I have in the portfolio that gives me the most headaches right now, that was a kind of a turnaround. It wouldn't be a classic case of a turnaround, but it's the biggest stress causer of the stocks that I own right now, because as Buffett said, turnaround seldom turn. This isn't exactly a turnaround, but it kind of is, and it's testing my staying power, because I'm not seeing the numbers that I would have liked to see as the business is progressing. So another rule so far, I can't say I have anyone that I disagree with. The one that could be considered sort of hellacious or scandalous would be the number of stocks to own, just because that goes against the diversification convention. But I like all the rules so far. Adrian, do you have any thoughts specifically on rule number 13?
Well, the first thing that came to mind was just thinking about when they talked about troubled industries. I mean, not too long ago, just think about the airline, cruise ships, and hotels. There was definitely some turmoil in those industries, and that, always caused some investors out there to say, hey, if there's a troubled industry, maybe there might be an opportunity here. And I guess what they're really trying to highlight in this rule is, if you really want to go that route, you have to find the most resilient companies that have the strongest staying power, that can weather any type of storm. And like we talked about earlier on in this podcast, the odds are against you, and typically it might not work out. It could, but it's definitely something where that's where you really have to focus on your work and your research as much as you can, if this is something where you think an opportunity is, where you can generate some profit.
Yeah, and going back to what I mentioned earlier, there's so many different companies out there that you can invest in. You can develop your rules for what you like in a company that can also help eliminate a lot of companies that you would not want to invest in. And I think this is one of now, these are all Peter Lynch's rules, but I think this was one that he talked about, of avoiding troubled industries. And if you're going into it, you've got to look at the companies that have the staying power, which also goes back to the balance sheet conversation. I think these rules do go hand in hand. So I really enjoyed reviewing and breaking down some of these rules, and I'm looking forward to the next episode. Adrian, do you have any final thoughts, rules that stand out to you? Anything you didn't like in summary?
Well, I just enjoy these rules because it just shows the conversations and the discussions that are worth having out there. And I know we had an episode not too long ago where we were challenging conventional wisdom, and I think that's the whole point of when you're looking at rules out there and just ideas or opinions, where you have to see what applies to you, what doesn't, what do you agree with, what do you not agree with, to really help you with your future decision making, especially when it comes to the investing world, which can sometimes be complicated, but also just a pivotal part of your situation.
Completely agree. We, as I said earlier, we like to help you find things that'll make you a better investor, better at planning, things that'll help you achieve, Adrian, as you mentioned earlier, that line up with your financial plan and help you achieve your goals. We'll be back soon with the other half of Peter Lynch's 25 golden rules. Take control and achieve your goals. This has been the Retirement Lifestyle Show.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither RTA Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of RTA Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through RTA Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through RTA Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.